Hi, welcome everyone to the Dallas Division December luncheon. Uh, would like to thank our 2020 year-long partners, Facets Appliances, Kitchens and Baths, Prosperity Bank, Foxworth Galbraith Lumber Company, and Riddell Plumbing. Now I'd like to introduce our year-long partner, Steve Puckett with Prosperity Bank, to say a few words.
Thanks, Richard. Good afternoon. I'm Steve Puckett with Prosperity Bank, and we're glad to be a 2020 year-long sponsor again here. Pleased to do this again in 2021 as well with the other fine sponsoring companies in support of our efforts. 2020 has been a tumultuous year to say the least, and we completed our merger between Prosperity and Legacy in the midst of all this, coming out much stronger, larger. We're statewide. Continued emphasis on portfolio style mortgage lending, including construction loan products. We have our one-time closed construction loan that I support, along with about 35 other loan officers in the Metroplex. We've improved that. I think that our program is cutting edge. We also offer development and spec lending through Eric Sonneborn's group with Robert Homan, who many of you may know. I think Eric's been a member here longer than I have. So it's good to be here today with Dr. Gaines. You know, the Texas Aggie football team may be stuck at number 5, but I think everybody would agree that the A&M Real Estate Center has been solidly entrenched at number 1 for a long, long time. And we've all benefited by the super low rates in place, banks, which translates to the building activity as well. But we're looking forward to hearing what Dr. Gaines has to say about the forecast for that. We were just chatting about that a bit as well. So it's good to have everybody here. We've got a lot of people on this call, and we're looking forward to seeing everybody. It becomes a possibility. But to continue a long-standing tradition, we always would give away a door prize. So I've entered everybody's name into a drawing for a gift card to Home Depot, and I'm going to pull that. Oops. Oh, are you there? So behind me, you'll see the Clyde Anderson Associate of the Year trophy that Prosperity Bank won this year at the virtual ceremony, if you saw that. So I've repurposed this trophy. Don't get worried, Phil. I didn't break it, but I've turned it into an urn. And inside are the names I'm going to draw for the winner of this fantastic gift card. And the winner would be Brian Smith of Smith Custom Building and Design. So Brian, I'll get your address and I'll send you this gift card. And Phil, I'll put the trophy back together and polish it up for you. So thanks, everyone. Enjoy the meeting.
Awesome. Thanks so much, Steve. Now I'd like to introduce the Dallas Builders Association Executive Officer, Phil Crone, to give us an update on permitting issues with the City of Dallas.
Thanks, Richard. And if only the City of Dallas was as easy to fix as the Associate of the Year trophy, we wouldn't be as worried about this as we are. But I'm putting in the chat right now a link to a story that I posted yesterday that just kind of gives an overview of the origins of this issue and certainly the impact that it's having when you have to wait 11, 12 weeks to get a building permit in the City of Dallas. You've got quite a bit of a problem. You cannot plan your business that way. You cannot achieve the city's housing goals that way. You just cannot function and provide a core function that a city should when you have delays like that. And I'm almost certain that we're going to see in the numbers in the road in the months ahead that play out. So Dr. Gaines, that'll probably be an interesting nuance in some of the data here, is that the city unfortunately is getting in its own way when other cities, every single other city, made the transition to a socially distant permitting process in a matter of days, to their credit, back in March. So where we are and where we're going is largely spelled out in that article. So I'm not going to bore you with all the details, but I will tell you that I'm starting to feel positive that the crisis that this is being fully realized by the entirety of the city council and the mayor, and the fact that staff's proposal that we get some semblance of normalcy by next spring, meaning that 11 to 12 week time frame becomes 3 to 4 weeks, that's just not good enough. We need to do better there. we need to get to that 2 to 3 weeks immediately and not sometime next year, at which point it will have taken more than a year for the city to do what every other city, as I mentioned, did in a matter of days. I've got a meeting with the other Eric Johnson, Dr. Eric Johnson, who is the assistant city manager, on Tuesday. I'm going to explain to him the gravity of this situation once more, as well as the immediacy of the fix that we demand. I'm not going to micromanage how they do it, but I don't care how you get here, folks, just get here. Like the old commercial said, we've got to have some improvements and it has to happen immediately. I've talked to a number of city council members who feel the same way. This came up in the mayor's state of the city address that he did back on Tuesday. And this is a priority for our leadership. Unfortunately, this is not a policy issue, or it would have been done and taken care of back in the summer. It's an administrative one, and it's an administrative one in a department, as many of you know, has some endemic problems that far predated the pandemic here. So we're going to keep working on it. I'm not going to stop until we get this fixed, we get the delays overcome, and we get that department functioning in a way that you expect it to function and that any city government should be able to function when it comes to core service that means so much for the housing goals and the economic development of our city. So again, check out that story. It's got a link to everything we've been doing in the media and otherwise, and the origins of this issue and the path forward, and also some things that you can do in terms of staying in contact with council members, which you need to do on these issues. Don't just be jaded about it, which I know there's a temptation to. Stay in touch with your council members and use those tools that we provide there, because that keeps it on the front burner. It keeps that wheel squeaking, and it gets us out in front to solve this crisis. So appreciate your support in that, and we're going to keep pushing, as Jeff Dworkin just said. So anyway, happy to help with any questions if you want to contact me, but please do look at that article, and we're going to get this done. It's one of many challenges that we have in the region, in this city, but we're going to overcome them and respond just like we have all throughout 2020 as an industry. So appreciate your time, and I'll give it back to you, Richard.
Awesome. Thanks, Phil. And thanks for your continued efforts in that area to get you and the association to get the permits back on track. We really appreciate it. We're about to start the webinar, but first a reminder, we'll be taking questions for the program. Please put any questions you have in the Q&A. You can find that feature at the bottom of your screen. Questions will be answered at the end of the program. Also, this webinar will be recorded and made available on Dallas Builders Association YouTube channel and Facebook. All right, without further ado, I'd like to introduce our keynote speaker, Dr. Jim Gaines, Chief Economist of the Real Estate Center at Texas A&M University. Dr. Gaines.
Well, good morning, everybody. Let's see if we can make the technology work here for us. Can everybody see the screen? If you can't, holler or send me a note or something.
Yep, I can see it.
We good? Okay. All right. I really appreciate the opportunity. It's been interesting the last 6 or 7 or 8 months, and of course for the home building market, the new home market has just been out of sight. So we'll just have to see how it goes going that. Let me start out and talk a little bit about the general economy. I won't bore you. At least I hope I won't bore you with a whole lot of details and stuff. But here's what we look like and what I think we're going to look like at least through the end of the year, through the fourth quarter of this year, which we're right in the middle of course. And what you can see is starting the first quarter, we were down 5%. This is the annualized percent change in real GDP. The second quarter, that 31.4, that was the worst that's ever been measured. And incidentally, again, it takes the change on the quarterly basis and annualizes it. So it's not a year over year. The year over year number was actually down just shy of 10%. I think it was like 9.8% on a year-over-year basis, second quarter to second quarter. But on an annualized quarterly basis from the first quarter to the second quarter, that's how you get to 31.4. Now, then we turned around, and in the third quarter of this year, we got a plus 33.1, and that's the best that it's ever been. Generally, the economy just doesn't change this quickly and this significantly in such a short period of time. We're officially in a recession starting in the second quarter. The National Bureau of Economic Research, the NBER, which is the official body of economists that declare when cycles start and stop and so forth and how long they last, declared February of this year to be the end month of the boom, if you will, or the expansion that took place starting in 2009, right after the Great Recession. So it went on for well over 10 years, about 11 years before that boom. And that's the longest on record, 128 months, longest on record. We hit first quarter this year, and these quarters, incidentally, if you're familiar with the rate of change and how things work, if you go down about 30%, you have to bounce back about 50 to 60% to break even, because you're measuring the increase from that point forward from a lower number base. So anyway, the way the world of arithmetic works, that 33.1, that's not a zero-sum game of those two rates of change. The 4 to 6 out there on the fourth quarter and a couple of question marks means we don't have a clue. And incidentally, let me preface, in fact, the whole rest of the presentation by telling you, there's an economist in the world right now that really knows what the hell's going on or how to predict what's going to happen in the future. We've never had this before. We've never had a pandemic where in 1 month, basically we fall off a cliff and then try to climb back up that cliff, the economic cliff, and recover and so forth. This just has not happened. The percentage change is similar to what happened in the Great Depression of the 1930s, but that took about a year to about 14 months before you had that 30% decline. We did it in less than 3 months. So it's we just don't have a model. We don't have any precedent for it. We don't really know how to put our finger on what's going on. And also, all of the recovery, everything, and you're going to see it. I'm going to harp on this in just a few minutes. Is based on the healthcare. So anyway, best estimate for fourth quarter. What are we going to look like by fourth quarter? I've seen it range. Actually, I've seen even negative numbers again for fourth quarter. I don't think that's likely, but somewhere between 2 and 12. I put 4 to 6% on the chart just as a sort of a best guess of what we think it might look like for the fourth quarter. The fourth quarter is going to be a little bit better, but as you're aware, we're kind of going through another downturn, another surge, if you will, in cases and so forth. And yes, I'm aware that we are going to start having vaccines available probably in the next 24 hours or so. And it remains to be seen. It's still going to probably take, even if people are willing to take the vaccine, which incidentally, it looks like about half the people in the country in the US don't want to take it or are going to refuse to take it. And that's a whole nother issue. But it's still, even at best, it's going to take 2, 3, 4 months to get the vaccine out. Here's the unemployment. Here's that falling off the cliff. From February, we hit bottom there in April, the end of April, lost about 20 million jobs in that period of time. We've bounced back about halfway. We had a pretty good bounce back in June, July, August, September. But here in October and then into November, you can see that orange curve out there at the far right is beginning to kind of level out. It's not still going back up to get us back where we were. We're still roughly 10 million jobs short down below of what we were in February of this year. And incidentally, if you'll remember, and I'm sure you do, January, February, and at least the first half of March, the economy was booming. The housing market was booming. The economy was booming, doing significantly better than the first quarter of 2019. But then by the middle of March, when the pandemic really hit and came into play, and with the shutdown and shut in and don't go out, and businesses closing and all of the rest of it, that was when we started going in the wrong direction. I just posted this morning, just before we got on the air here, that last red bar out there to the right, and it's kind of disturbing, but it's reflective of what's going on. The number of initial claims for unemployment bounced up about 135,000 from the previous week. And you can see it went up close to about 850, I think it was 853,000 was the number that came in. And you can really see, if you look over there to the left, that's what unemployment claims ought to look like. Those little stubby black bars, that's before the pandemic. That's the first 2 or 3 months of the year up until March 14th. And then that's what it ought to look like, between 200 to 250,000 claims a week. So if we're running 750 to 1 million claims a week, we're running 3 to 4 times the normal amount of unemployment claims. And of course, as you're also well aware, all of the supplemental or stimulus unemployment benefits, particularly the $600 a week in additional unemployment insurance money being spent or paid to unemployed people, gave out a couple of 3 months ago now. And it took about 30 to 60 days for that to really churn through. But now it is becoming a more significant setback and restriction on what the employment and what the economy is doing. The unemployment rate actually has come down to 6.7%. That's a little misleading. And yes, we have added jobs. I've got them listed there from May through November. And you'll see that November was not that good. It was 250,000 jobs, 245,000 jobs. That isn't a whole lot to try to recover this economy. That's that bar you saw kind of leveling out there on the previous graph. The reason the unemployment rate is down is because we have so many people that have become unemployed and are categorized now as permanently unemployed and therefore are not counted in the labor force. So it's the denominator of the equation has been declining, causing the unemployment rate to look better. The U6, the more reasonable or more real rate, is still up double digits, 12%. That's the rate that really you probably need to pay more attention to. Here's what it's going to take, and this is what I was alluding to just a minute ago. The number one thing that's going to take is that we've got to get the virus under control. We don't have a snowball's chance of getting back to true quote unquote normal, whatever that is, until or unless we get the virus under control. What we've been waiting on, of course, is some kind of a vaccine that either immunizes or is a cure or a treatment if you get the disease or something to reduce the risk and reduce the uncertainty and the fear that's prevalent in the economy and in the marketplace and among consumers and buyers. We probably will never eliminate COVID-19 completely. We haven't eliminated the virus with the flu and the various forms and strains of the flu, the bird flu and the swine flu and all the other flus that we've had over the past 20, 30 years. So it's not reasonable to expect that we're going to eradicate it, but we got to do something that looks like we at least have it under control or down to acceptable levels. And we can treat it for people who get the disease, then we can actually treat them with something maybe more than a ventilator and so forth in a hospital. That we got to get something there. Now, and once that happens, and as we are doing that, and hopefully that we're seeing the beginnings of that now. I still think it's going to take 2, 3, 4 months maybe before it really is going to come into play. We're seeing the effects, but then we'll re-employ people. All these people, we still got little about 10 million people that need a job, that need to go back to work. And of course, that's concentrated in the people services businesses, the healthcare, the restaurants, the bars, barbershops, spas, tanning salons, workout facilities, and so forth. That's the leisure and hospitality group, and the retail sector, of course, have been hit the hardest for people losing their jobs and not having the kinds of jobs where they can work remotely as we're doing here, but have to work on site and with and around people. And of course, some of you, I'm sure, are experiencing this with your work crews and your subcontractors, with their employees and so forth, having the same kinds of issues. All of this will lead to money. All of this will lead to an increase in overall demand, both consumer demand of people getting out and buying things, as well as business demands. Business to business and business to customers has been sorely lacking. Services spending has been down significantly. Retail spending has actually recovered. A lot of it, and a great deal proportion, almost twice to 3 times historical norm in e-commerce, but nevertheless, total retail sales back up. But durable goods, cars, and so forth have not been quite as helpful. Our exports are down, our imports are up. I read a report here not long ago that virtually every cargo tanker in the world right now is active and moving around and moving things around the world. But from the U.S. standpoint, we're having a real significant negative or deficit balance on our trade, as we are importing significantly more than what we are exporting. There's nothing new with that, but it's still there. Inflation right now is not an immediate concern. It probably will be later, and by later, I'm talking maybe at least a year, maybe 2 years from now. We might see the inflation rate start creeping into that 2.5% to 3.5% range per year. And at that point, that's about when the Fed will probably start raising interest rates again. Just until then, interest rates are probably going to stay low. One reason inflation is not likely to go up very rapidly is that household and personal income has not been going up as rapidly as other things. So we're getting cost push, but we're not getting the wage pull on the inflation rate. Taxes and spending, I'm going to tell you right now, taxes and spending at government levels are going to go up. They don't have a choice. It's not going to hit this year. It's going to start hitting next year, and then particularly into 2022. Start watching out for it. It's going to start coming. The debt that right now, necessity is the mother of invention. They've been calling all of these the CARES Act and the PPP program and the unemployment insurance claims additional stimulus payments. They're not stimulus payments. They're survival payments. And so when you've got in a survival mode, yeah, you go into debt, and debt to GDP ratio is it's above what it was in World War II, and that was to finance a world war. We're now running close to 135% of total national debt to GDP, annual GDP. A lot of concern there. It is something out on the horizon. The debt that maybe as home builders you probably should be much more aware of is the student loan debt. It's affecting the millennials, the demographic group that's a home buying age, maybe more and disproportionately more, of course, than all the other demographic groups. And I know there's been a lot of rhetoric here about the change in administration that we're going to get in January. and what they're going to do with the student debt and forgiveness and all of that. But that's a biggie to watch out with. Corporate debt is the other one, though, is to watch out. Corporate debt has gotten well out of hand. Here's the wave that's going on right now with the new cases. If you haven't seen this kind of a chart up to this point, you need to see it. This is what we got to get under control. That blue line just took off, and particularly accelerated at and during after Thanksgiving, and is probably going to bounce up some more here in the next 2 or 3 weeks. The effects of Thanksgiving, of congregation and travel and so forth, it probably takes a couple of weeks for that to show up in the data. So we had a little bit of a fall off literally at Thanksgiving week, but watch out here this week, next week, and the week after in terms, and then we're going to hit the Christmas holiday season. And so it's going to probably be after the first of the year into January before we start seeing any kind of real substantive control or decline in this new cases thing. Let me jump to Texas. Similar graph in Texas. We're experiencing the same thing. Texas opened up the economy earlier than a lot of the other states, as we're well aware. Back in June, the governor allowed more meetings and so forth, and we had our spike up that occurred back in July, and then in good order, we were coming back down. It looked like we were going to get things back under control. The school opening there in September, late August, September, gave us another little bit of a blip, and then got that kind of taken care of. And then, but since then, been going up and going up rapidly. Got a fall off here right at the Thanksgiving period, but again, it's starting to bounce back on the post-Thanksgiving period. The death rate, the good news here, though, if you look at the orange line, is down and sort of staying down. So the number of deaths per 1,000 cases or per 100,000 cases is down significantly. It's affecting old people like me more than the rest of the population, but it's very different. And as you well know, Texas got hit with a double whammy here. We not only got hit with the pandemic in March, but actually starting back in January, when the Saudis and the Russians decided to have a price war and go to war with each other, price of oil wise, and their secondary target was the American fracturing industry. We had oil prices just completely come off unglued. You can see it starting in January, the orange line, the dip in the orange line, going down to in April. On one day, it actually went negative, as many of you recall seeing the headlines. And literally what was happening, the producers were literally having to pay somebody to take the oil off their hands. That's a negative price. It only lasted, fortunately, one day, but at least for that week, the average weekly price was something like $3.50-something. And that's that dip, that low point there in the orange line. Now, since then, you can see it bounced back up fairly quickly. And it has been running more or less in that $40 barrel range, and now is kind of approaching the $45 a barrel. And a lot of these so-called experts, I'm not sure anybody, predicting the price of oil is like trying to predict interest rates. It's a losing proposition. But a lot of the experts are saying, yeah, the price probably will go back up into the 50s if the Saudis and the Russians and some of the other OPEC nations kind of get their act together and work. The rig count has tried to rebound, hit a low of right at 100 rigs from a high you can see over there in 2018 of 540. Current rig count running just under 150. And that's basically the best we can say for the energy sector of the economy for Texas for the coming year, for 2021, is that it'll probably be neutral. It's not going to be a stimulant, but hopefully it is not going to be much of a deterrent. It's not going to be a big negative. We've already had most of the negative job losses and so forth that's associated with the decline in the price. And actually for the Dallas-Fort Worth market, I can tell you that we've watched the correlation on the energy sector on the local market there. It's not very high. So for example, back in the 2016, 17, 18 period, back over there to the left, Dallas-Fort Worth just flew right through that, didn't even feel much of the energy effect at all. You know, you've heard me say before that J.R. Ewing notwithstanding, Dallas-Fort Worth is really not an energy or an oil and gas market metropolitan area, really. So it's not that big a deal. In Texas, we don't have the latest. Texas runs 2-3 weeks behind in terms of getting data. Probably no surprise to anybody. And so I don't have the November number or the most current numbers. This is the most current that I've got. And you can see it's a similar situation in terms of unemployment claims. We still have about over 500,000 people filing for unemployment on a regular basis. Almost 4 million people did total cumulatively have filed, but we're adding back jobs. October was 118,000. November, it's a little bit early to call that one. We'll have to see how it works. Here's what it looks like in terms of the graph. We're not nearly as bad off as the US. We're down about 4% October to October, year over year. We're down a little over 500,000 jobs, almost 550. And at least the trend is back up, but it's probably going to be toward the second half of 2021 to get back up to where that blue line was trending and going in that direction. It's just taking a while. This is the closest thing we've got to a V-shaped recovery. We did some calculations here at the Real Estate Center to look at how each of our metropolitan areas in Texas were doing in terms of recovering their pre-pandemic level in terms of number of jobs. So based on the fact, and you can see Dallas-Plano-Irving, the DPI, the east side of the Metroplex is doing quite well. It's about 97%, about a 3% shy. And you see Fort Worth is a little bit right at about 95.5%. Texas overall is at about 96. Fort Worth, Arlington, the manufacturing sector is a little slower to come back. Some of the jobs there, obviously, when you have more hands-on type jobs and that sort of thing, as opposed to business services jobs, which can work remotely or are better suited for working remotely. So Dallas-Plano-Irving, the DPI side was a little easier to get back. Houston, you can see, is on down the list, mainly because of the energy sector being different. And taking some while to come back, but this gives you an idea. And then at the bottom of the list, you can see easily Odessa and Midland. They're still suffering from the energy impact mainly more than the pandemic, quite frankly. As is Corpus and San Angelo and Beaumont, Port Arthur. It's not surprising that those communities would be sort of at the bottom of the list. Here's what we look like at least through October. A year ago in October, you can see that unemployment rate we were at full employment. You know, when you got an unemployment rate around 3%, you're not hurting at all. It went up to as high as 12.6% for Dallas-Fort Worth in May, back down to about 6.1. I suspect that what it's going to do here for 2021, it's going to get into about 5.5. Or thereabouts, and that's going to look kind of like full employment for us. Here's the Dallas-Fort Worth cases, and you can see that there's been a pickup here in the last month or so, a significant pickup. This again is going to affect the local economy in terms of general recovery. The blue line there is the 7-day moving average. The bars are the daily numbers. It is getting interesting, and it's going to be interesting particularly if and when we get the vaccine out here in the next 30 to 60 to 90 days, if we can really make a significant impact on the height of those bars and then get that blue line to come back down and maybe be under 100. and be careful. The Dallas-Fort Worth market is, like I showed you here a minute ago, it's down about 2.6% year over year. About 133,000 jobs down right now, lost almost 700,000 jobs between February and April. I mean, that's falling off a cliff. That's so quickly, just 2 months, March and April, to drop down to that level, and then trying at best to come back up and see what happens. As that curve comes back up, the economy will pick back up. Here's our best guess. And like I said, no economist can really predict anything with the whole degree of certainty. I'd much rather give you a range that I think the growth in jobs this year will be somewhere between about -1% to about 0. I'm basing it this year, probably by year end. We've only got this month and this month, November and December data that we don't have yet. Probably is going to look like a down about a 1.5%. I do think though that next year be about 2.5%, but of course that's going to be measured off the lower base from the 2020 number. So it'll the percentage increase might look a little better than what the total numbers, because what you see is it's just slightly above 2019 if it goes back up at about 2.5%. But I think that's a reasonable projection. Dallas-Fort Worth is still a growing area. It's still an attractive area. People are still moving to Texas. They're still moving to Dallas-Fort Worth. Jobs are moving in. Jobs are going to be created. Some of the companies that are going to be lost, the restaurants, the bars, the personal services businesses that have closed and may never reopen, they may reopen, but under different names or different ownership, but the entrepreneurship coming back in and people starting new businesses and so forth. So we'll just have to see that how that happens. Dallas-Plano-Irving, I'm hitting the DPI side, the east part. This is, as you can see, the Collin, Dallas, and Denton counties are the three big counties in the municipal division, and so you can kind of see October to October it's down 2%, about 55,000 jobs short, and well on the way toward a general recovery. And like I say, probably figure on mid 2021 or so. Second, third quarter to come back to where it was, just to come back to break even, if you will, and going back on. Let me jump into the housing market. I mentioned interest rates are going to be down. The Fed funds rate, that green line, is going to hover right there and parallel the 0 line for the foreseeable future. I didn't take this out very far because anybody who tries to project, but the 30-year fixed mortgage rate, that's the Freddie Mac 30-year rate. Right now it's running at about 2.75, 2.8% on that's being reported. Obviously, if you go 15 years, you can get down to probably 2.25 or somewhere in that vicinity, maybe even to 2.125, depending on the lender. The 10-year Treasury, the 30-year is going to more or less parallel the 10-year Treasury, always has. It is trying to bend back up. Most people are not expecting that rate to go up much more than a little bit over 1%, maybe 10, maybe 20 basis points. That'd be 1.2%, but still to be staying at more or less a historic low. I mean, you can see at least since 2007, this is a historic low, the 10-year Treasury being that low. The home builders around the country are just ecstatic. As measured by the Wells Fargo National Association of Home Builders Home Market Index. This is, if you want to look at it this way, it's an optimism index. It's a composite of about 6 or 7 or 8 different things. Some of you may participate in the survey about foot traffic and expected sales and so forth. But hitting that 90 level, that 90% of the builders that were surveyed said that things are good, that it's looking favorable, and that they're optimistic. And you can see the housing starts, the orange line, had the same slump back in June, July, and then has since bounced right back up and is approaching and is in fact exceeding the million unit a year, close to 1.2 million, 1.1 million units a year on a seasonally adjusted annual basis. So very good news there. New and existing home sales, as most of you are well aware, around the country are taking off and exploding. The low interest rates, the pandemic effect, if you want to call it that, has spurred people to look for space. They're looking for, especially if they've been cooped up in an apartment the last 4, 5, 6 months and can't get out. You'd much rather have a house somewhere with maybe somewhere 18 to 2,200 square feet instead of a 750 to 850 square foot apartment, and get out and have space and maybe a yard for the kids, especially if you got kids. And of course, the millennials, the demographics are working. The 26 to 40-year-old age group, but particularly the 36 to 40, that older part of the millennial generation is hitting the home buying market hard. They're coming into play. And if they can't find an existing home, which they can't in many cases, they are looking to buy new homes and contracting accordingly. All right, in Texas, Texas home sales, I mean, we are taking off. Texas indexed level of sales going on. While the US is doing well, Texas is just doing outstanding. We were predicting this year that yearly annual home sales would probably increase about 3.5% and prices going up 4%. I can tell you that year to date, and I just got the numbers this morning for November, quite frankly, and we're up. It's incredible what we're up. We're up 7%, both in sales and price. So my purple bar over there is going to be conservative. It's going to be greater than that in terms of the annual home sales. Here's what's going on though. We've got a limited inventory, especially in the key prices, especially in that price bracket of 200 to 350. People aren't selling. If everybody's refinanced at 3% mortgages, and us boomers aren't moving, and even if you wanted to move and move up or move over, you can't find anything, so you're not selling the house and then go to find something. You got to find something first. So that limited inventory. I think it's fair to say that most of the home builders that I've been talking to and know about are building homes just about as fast as they can. They're running out of lots. As Phil was talking about, just even getting a building permit, if you're in the city of Dallas, now taking, if 12 weeks is 3 months, I mean, that's nuts. But of course, a lot of the construction and a lot of the activity is out in the outer rings, if you will, of the area, in the suburbs and the suburban counties. Again, the move for space, but also the move to find land at affordable prices to be able to build homes in that sweet spot of 200, 350, or 200,000 to 400,000, something like that, if you can. Affordability is of course relative to incomes. The thing that we're watching is the rate of increase in home prices relative to the rate of increase in household incomes. And right now, the price of housing is clearly outpacing the increase in income. And that is going to be an issue that is going to have to be addressed in the next year or two on the affordability issue as it gets there. We're going to have the historically low interest rates. They're going to be the main draw. I've read an interesting article here just this week about the home builders around the country redesigning their products because people are going to be either moving back in with their parents. And incidentally, in the last 6 months, something like 35% of the people between the ages of 18 and 36 have moved back in with their parents. That's one reason the home ownership rate that's being reported has exploded, is because quite literally there's fewer households. We've got people in the rental market that now are doubling and tripling up, or moving back in with their parents. And when all of that happens, you reduce the number of households. So if the home ownership at all goes up and then the denominator of that equation goes down, the percentage of home ownership goes way up. So it's 70% right now. Never been that high before. But historically low interest rates, the demographics, and then the ease of mortgage financing. And that's an issue here that's in a certain amount of volatility. And on the one hand, lenders have made home loans available and easy to obtain and so forth. But recently, a little more of a trend to, okay, I want a higher FICO score or more down payment or whatever, except the GSEs, of course, are trying to lower all that and make things, Fannie and Freddie are trying, and Ginnie Mae are trying to make things easier. So FHA, VA loans are very prominent, particularly in those lower price points. And that's going to lead to some issues later on. It's not a subprime mortgage market at all, but it is, and there's segments of the market that are bordering on being much higher risk loans. And we're going to have to see how that plays out in the future. And of course, for most of the buyers right now, a lot of them have a lot of concern about the general economy, their job, how secure their job is. If they've lost their job, they're in trouble. If they've gone into forbearance and so forth with their mortgage, there's going to be a big play. 2021 is going to see a lot of changes going on and a lot of negotiation of what do we do with people that are 6 months, 7 months behind in making their mortgage payments, got into the forbearance program so they couldn't be foreclosed on, but are they going to get refinanced? Are they going to get evicted? Are they going to get foreclosed? Are they going to somehow have to try to make up those payments? We don't really know the structure and the magnitude of how all that is going to play out as we go through into the future. Home building, and it was interesting listening to Phil talk about the problems here in Dallas. Single family home building is up about 17% in the state. You can see that green bar. I just went ahead and projected out for the rest of the year. And 2021 might be up another double-digit percentage rate as well, because I think going into 2021, there's such a backlog and such a movement forward with the demand. And now it is, of course, taking a little longer to build homes to get them up. So the home building industry is going to have a very good 2021. I don't know if it'll get up to that 166,000 that we had back in 2005, but it's probably going to be approaching, it could approach very easily the 160,000. You can see that'll be 16 years out, which is about parallel to what we did back in the 80s to recover from the depression of the 80s. Here's Dallas-Fort Worth third quarter results. Median price up 9%. That's almost more than you want. But some of that is because if you look over to the right, you'll see that nearly 16% of the homes being sold are greater than $500,000. And that's the market share for that end of the market is significantly greater. That market share normally was running 8-9%. And so to now be up, to over 15% of the market, that's one of the things arithmetically bringing up averages and medians. You can still see that the real sweet spot is the 200 to 400,000. I mean, there's where your sales are going up. Closed sales are up 18%. But look at the active listings. That's what I was talking about this shortage of inventory, down almost 40%. And the months of inventory at less than 2 months. Let me tell you something, in Aggie speak, you ain't got none. So that's a real problem. Here's what home sales, and I just updated this morning. I just got this map this morning about 9 o'clock this morning. You can see the predominance of green on the left. That's the home sales by zip code of being up over 11%. And yeah, there's some areas that are suffering a little bit, but you can especially see how that green pervades outside of the immediate downtown area going out, because this is the multi-county area. This is This is, you can see all the way up north of Frisco, McKinney, out toward Decatur, Weatherford, down toward Waxahachie, so on. So, and then the home prices are up about 5.1% accordingly, and you can see that home prices are moving the same kind of way. Annual home sales in the Dallas-Plano-Irving metropolitan district, if you will, up also. We're looking for sales to be up at least 2%, and quite frankly, it's going to be more than that. It's going to probably be up closer to 5%. Prices are going to be up around 8%. We'll just have to see how that's going to play out. Monthly sales in the area have really taken off since the April-May time period. You can see there, and the new home sales, and this is trend adjusted, seasonally adjusted. I've taken out all of the real volatility in these curves. If you really just track the actual numbers, it's really difficult to see it. So there's some statistical things have gone on with this, just so you can see the trend of how it's going and which way it's going and what it's looking like. Here's again year to date in the eastern part of the metroplex of where home sales, and look at 72% of the sales are between 200 and 500,000. Almost more than a third are between 200 and 300,000. So you can see how that is going, in that 15% roughly that are over 500,000. And you can see how the month's inventory, again, it ought to be at least, these are new home sales. These are new home sales. This is not the total market. This is, and incidentally, when I say new home sales, these are the new home sales that have been reported through the multiple listing services in the area, NAHB data. So it's not only Metrotex, but it's all of the boards or any of the MLSs that cover the area of the Dallas-Plano-Irving Metropolitan Division. And for the new home market, roughly a five month inventory of available homes is kind of a balancing number. And you can see that even on the upper price market, the 500,000 plus, it's right at 4 months instead of 5. So it's really, really short, and of course, virtually nil at anything less than 200%. So, or $200,000. So it's a real difficult market here, but you can see where that sweet spot is and how sales are going in the area. Months inventory, you can see how it's going, downward trend, and don't see much happening there to really get that changed. Home prices are going up significantly, much greater than the trend that was pre-recession. The blue and red lines before the Great Recession, and then if you just extended them out linearly, the dashed lines, and you can see then what really happened since then, since 2008-9. Yes, we had the dip down, but by 2013, back up on, and not only to trend, but significantly above trend for both the average and the median home prices. So it's the Dallas-Fort Worth area, though, is still a competitive market compared to other national markets too. I mean, we're the fourth largest metropolitan market in the country, and probably and easily the most affordable of those markets for new home prices. Annual new home sales up about 12.4% year to date. Just going off the chart again. So that 11,270, that's year to date sales. There's 2 more months of sales that need to be stacked on top of that before we'll be able to really compare it on an annual basis. But you can see where it's come from. Even back in 2015, 2016, then the big jump in 2017, and then since then continuing to go up as well. Median home price Really, this is the good news. As home builders have been trying to hit that 200 to 350 sweet spot, if you will, it's kept the median price, the overall median price of the new homes that are coming through the MLS systems, at least, it's keeping it in check, so that it's essentially it's flat since 2016. I mean, one way to look at it, 1% plus or minus is more or less flat. And again, remember, these are new home sales that went through the MLS. A lot of these will probably be non-contract, sales and so forth. Single family permits, and now I understand if you've run into these kind of delays, why the permitting isn't up more, but it's still nevertheless up 19% on a year-to-date basis as I looked at the monthly data. So that 25,540 out there is just through October. I don't think I have the November numbers. So there's still November, December numbers to be tacked on top of that. So it'll probably go up. It's interesting because 2019 was actually a slightly down number for total single family permits in the area based on relative to 2018. So it's coming back up more or less to the 2018 levels. This is good news. I mean, you can see the trend is still going, still not getting that 2004, 2005 market, but it's interesting to see how that's going on and going to be played. As an economist, the best two words you can ever hear me say is in conclusion. Here's one of the things we're looking at here going into 2021. There's going to be some forbearance going into foreclosures. The delinquency rate is up. We can see it coming. It won't be anything like the 2007, 8, 9, 10 levels of foreclosures. It's just not that significant. Also, with home prices being up significantly, a lot of people will be able to avoid some of the problem by simply selling their house and getting out. And that may be a boon, incidentally. We were talking about it with some of us before we got on the air here. That might be a boon to that single family rental market of people who are sort of forced out of their homes that they own because of the forbearance and foreclosure, sell their property and then go rent another house rather than going into an apartment. The moratorium on evictions and so forth is basically going to give out here probably year end. That's up in the clouds a little bit. Low interest rates are going to continue to stimulate housing demand. That isn't going to go away. The 2021 market bottom line is going to be a good, solid, strong market unless something significant happens that we don't anticipate. If the vaccine doesn't work or proves to be inconclusive or something of that order, or the pandemic gets so much worse or something on that order and forces more layoffs and job losses. But right now, that's a low probability. It's also true that the real estate market, construction, brokerage, sales practices, property management, land development, everything has adopted new techniques, new processes, new ways of doing business. I'm sure all of you have been hustling to stay on top of these things, and this is going to emerge in the long run, and even in the short to medium run, making everybody really a little bit more productive, getting more out of what you got and doing it better. Home construction is going to be the prime recovery activity for the US economy, for the state's economy, and for the economy of Dallas-Fort Worth. It won't be alone, but it's going to be one of the definite leaders. The commercial markets, right now, they're just kind of getting a handle on what's going to happen. We know that the retail market, the hotel market, is in for major repricing, revaluation. That's going to show up in investment values. It's also going to show up on property tax rolls. The office market is a little bit more difficult to make a call on. Leases are longer term and so forth. The warehouse distribution market has been really exploding because of the e-commerce, the need for logistic and warehouse space, but it could create some over construction we'll have to see how that goes. So right now on the commercial side, kind of a wait and see. Some of the value impacts we haven't seen on the commercial side. Housing most definitely going up at very high rates of increase in terms of overall values. Our repeat sales index for Dallas indicates about a 5.5% rate of increase in real home values. And we find that much more realistic than looking at the changes in averages and medians. Well, I appreciate your patience and listening to me. I hope that I have given you something to think about, and we'll see if we can stop there. I think we have a few minutes here before we give out of time. I went a little longer, Richard. Sorry about that.
You're good, Dr. Gaines. Thank you so much for all this insight. Let's look to see if we have any questions here. Looks like Jeff Dworkin says, is it possible that new home start reaches the blow and go early 2000s in DFW, i.e. 52K, constraints on labor and supplies?
It's possible. The two limiting factors that we're aware of is developable land and developed into finished lots ready for building. What I'm hearing more and more, so you guys tell me, is labor constraints, particularly for the subs. It was already a constraint before the pandemic. It was an issue of finding enough numbers of trained or skilled workers before we went into COVID issues. And now the COVID, and with distancing and masks and all of the other stuff that's going in with it, has just sort of exacerbated. So yeah, I think it's possible. I'm not going to predict it, but it's sure possible, because the market is still exploding, and the in-migration to the area and the people who are looking to move out and over out of apartments or over from one home to another home, that demand has not let up at all, and shows not enough impetus to let up. And yeah, I'm seeing your message there, Jeff. Yeah, that's what we're talking about, the trade skills, the plumbers, the electricians, even framers and cement and truck drivers for the cement trucks. I mean, all kinds of the skilled and semi-skilled labor pool is somewhat restricted.
Gotcha. All right. Well, looks like I don't see any more questions. So let's see. Was there one that just popped up here? How will the 55 plus buyers market impact DFW market in terms of units bought and price paid?
The old farts. That's me. No, the seniors market. There's going to be most definitely an increase in demand for senior care, non-assisted living, the 55 plus, the senior subdivision or development. I think you're going to see that, because if you just simply look at the demographics, that the number of people that falling into that category is increasing dramatically every day. So yes, that is going to have a very real effect. The interesting part on the 55 plus are the ones who already own a home are not, right now, they're not showing the inclination to sell. That's what's hurting the inventory on the existing market side. The aging in place, the average tenure, for example, of living in a house, the realtors will tell you that 10, 15 years ago, the average run was 5 to 7 years. You lived in a house on average 5 to 7 years, and then flipped it or went to another one. That number now is ranging 9 to 12 years. And that's part of that restricted supply on properties being offered for sale. So the 55 plus market is both an influence on the demand side, but it's also an influence on the supply side.
Gotcha. Looks like Alan Hoffman's got a quick question. Let's see. How do you determine the inflow numbers of out-of-state purchasers?
Well, right now, that's a guesstimate right now. I can tell you from our data that we get at the real estate center, we don't know. We simply don't know anything really about the demographics of the buyers and sellers. Now, most of you should be aware that NAR just finished its annual survey on buyers and sellers, and they do a subset of that for Texas. And within that report, and you can get it from NAR or you can get it from the Texas Realtors Association, for those of you who are members or have access. And they do have some estimates of out-of-state buyers, but out of town. I mean, if you think about it, a lot of the people who are moving to Dallas-Fort Worth area are not only from out of state, but really just from out of town. They're from other areas of Texas moving to the Metroplex. And so it gets a little confusing, but for out of town buyers, there's still a very strong move that way. You can also check with the moving companies, Global and Northwestern and United Movers the van move. They'll tell you where those trucks are coming from and where they're going to.
Gotcha. Awesome. Well, Dr. Gaines, I'd like to thank you again for your time and information here. Thanks everybody for tuning in. Want to wish everybody a happy holiday, Merry Christmas, and Happy New Year.
Thank you. Same to everybody else.